wondered why people make such weird decisions when it comes to money? Like, why do we hold on to losing stocks but sell the winning ones too early? Or why do people follow the crowd during market bubbles and then regret it later? Well, welcome to the fascinating world of behavioral finance. It's a field that helps us decode the psychological quirks behind financial decisions. In this video, we're diving into what behavioral finance is, its history, and why it matters. Well, we'll also look at the cognitive errors and emotional biases that influence investors. Most importantly, how can we overcome them? Let's get started!
Okay, so what exactly is behavioral finance? In simple terms, it's a blend of psychology and economics that explains why people don't always make rational financial decisions. Unlike traditional finance, which assumes we're all logical robots calculating every financial move perfectly, behavioral finance says, hold on, humans are emotional. And they mess up sometimes. For example, instead of always maximizing gains, we might hold on to a bad investment because we hate the idea of realizing a loss. That's exactly what this field is all about.
Now let's take a closer look at the history of behavioral finance. It's a fascinating story that shows how this field evolved from being just a niche topic into a game changer for investors, policymakers, and even everyday savers. It all started in the early 20th century when psychologists like Sigmund Freud began exploring how unconscious thoughts and emotions influence our decisions. Around the same time, economists like John Maynard Keynes pointed out that financial markets are often driven by animal spirits. In other words, human emotions like fear and greed. This was one of the first acknowledgments that markets are not purely rational.
Talking about the history of the behavioral finance, its pivotal decade came in 1970s. So Daniel Kahneman and Amos Tversky, the two psychologists, changed the game with their prospect theory. The theory was formed when they discovered that people don't evaluate gains and losses equally. For example, losing a $100 hurts way more than the feeling of gaining a $100. So the fear of loss is known as the loss of aversion. And this loss of aversion explains why we make irrational decisions, like we hold on to bad stocks or avoiding risk that could pay off in the long run. So the story doesn't stop there. During 1980s and 1990s, behavioral finance finally took off, thanks to the economist Richard Thaler. So Richard Thaler built on Kahneman and Tversky's work and introduced these concepts: mental accounting, Indomie effect, and the status quo bias. So in mental accounting, it is the way we mentally divide our money into categories, like we treat our bonus as fun money and our salary as a serious money. And for Indomie effect, it is the tendency that we overvalue things simply because we own them. And then for the status quo bias, it is a preference to stick what we know even when change could be better.
Fast forward in the 21st century, and behavioral finance has become a core part of economics. It's no longer just an academic topic. It's used by regulators, companies, and investors who design better financial systems. For example, Robert Shiller, who won the Nobel Prize in 2013, used behavioral insights to explain why markets experience bubbles and crashes. And Richard Thaler, who won the Nobel in 2017, popularized nudge theory, which helps governments and businesses encourage better financial decisions like saving for retirement and avoiding debt. Behavioral finance has shown us that understanding why people make irrational decisions is just as important as understanding the market themselves. And that is why it is such an exciting field.
Alright, now let's break down big ideas in behavioral finance. cognitive biases, and emotional biases. Cognitive errors are mistakes in how we process information. Think of them as glitches in our mental software. These errors happen because we rely on shortcuts or heuristics that sometimes steer us wrong. Emotional biases, on the other hand, come from how we feel. They're based on personal emotions and often override logical processing. The key difference is this: cognitive errors are about flawed thinking, while emotional biases are feelings taking over. Both can lead to irrational decisions, but in slightly different ways.
Let's take a closer look at examples of each category, starting with cognitive errors. Confirmation bias. It's seeking for information that only coincides with what we already believe. Example, an investor that totally ignores negative reviews about stocks he already prefers. How to deal with it? We just have to consider all opposing viewpoints and use objective data in making decisions. Hindsight bias, believing after an event that you knew it all along. Example, claiming that you predicted a market crash after it happened. What to do? Record pre-decision reasoning and evaluate it later. Anchoring and adjustment, relying too much on initial information even when it's irrelevant. Example, pricing a stock based on its historical high, even if market conditions have changed. What to do again? Reassess values based on changing fundamentals. Availability bias, overestimating the likelihood of events based on recent dramatic example. Example, avoiding flights after hearing about a plane crash. That's me. What to do? Base decisions on comprehensive data and recent events. Framing, decisions influenced by how information is presented. Example, seeing 80% success rate and feeling more positive than hearing 20% failure rate. So that's just how you hear things, okay? And solution to that, reframe scenarios to analyze them logically.
So aside from cognitive biases that makes an investor irrational in deciding on how much and where to invest, we have also emotional biases. So first, we have loss aversion. So it is the fear of losing something. It's more than valuing equivalent gains. So example of this is we are holding on to a losing investment because selling it feels like that we are admitting defeat. So how to solve this is we have to set stop limits and evaluate investments based on future potential and not the past cost. Next is overconfidence. So it is an overestimating our abilities and knowledge in managing or investing our money. So example of that is we are making risky trades without proper research. So to solve that, we have to rely on diverse perspectives and adhere to a structured investment process. And another solution is to make decisions based on clear goals and evidence and not emotion. So another emotional bias is the regret aversions. This aversion is avoiding decisions to prevent potential regrets. So example of this is we are not selling the stock because we have the fear that we will miss out the future gain. And the next and the last, which is the Indomie effect. This emotional bias is like you are overvaluing something simply because you own it. So example of that is you are refusing to sell an asset at market value because you believe it is worth more. The solution for this is regularly reassess holdings objectively.
These biases affect all of us. But the good news is that by recognizing them, we can make better financial decisions, whether it's avoiding risky investments or challenging our assumptions. Understanding behavioral finance can really help us level up our money game. Now, let's talk about how this all applies in real life, especially here in the Philippines. In Filipino culture, a strong sense of family and community often shapes financial decisions. For example, we might hold onto ancestral properties, even when it's poor financial move, because of utang na loob or debt of gratitude. In investments, chismis, yes, gossip, often leads to herding bias. If everyone's buying into an IPO or trending stock, there's this pressure to jump in even without understanding the fundamentals. There's also a tendency to overvalue owned assets, like keeping an owned family business alive at all costs, even when it's no longer profitable, because of sentimental attachment or the fear of disappointing family expectations.
On a broader scale, loss aversion plays a great role on how Filipinos manage their finances. So many avoid higher risk investments like stocks or mutual funds and instead investing to savings account or informal savings like paluwagan despite the inflation eroding the value of their money. To overcome these emotional biases, it is essential to focus on financial education. Practical strategies including using tools like budgeting apps or attending seminars on investments, or even consulting financial advisors to make decisions based on data rather than emotions. And honestly, embracing a healthy skepticism toward investments or chismes can save a lot of heartaches.
Quick tips for our fellow Investopedia investors. Tip number 1. According to Natal et al., managing finances during periods of economic uncertainty, such as global inflation, involves adjusting spending and saving habits strategically. In the Philippine context, where economic resilience is often shaped by cultural values and resourcefulness, individuals tend to prioritize essentials like food, utilities, and education while reducing discretionary spending on non-essential items. Filipinos also lean on community-based financial practices such as paluwagan or informal savings group to buffer against economic challenges. Applying these principles to our MBA stock trading game, we can adopt a similarly pragmatic approach to investing. For instance, focus on building a well-diversified portfolio to reduce risk. I've tried that. Identify sectors with long-term growth potential like renewable energy or technology, and avoid impulsive decisions driven by market noise. Just as Filipinos prioritize financial stability in their daily lives, we can approach stocks trading with discipline, ensuring that our decisions align with strategic goals rather than emotional biases.
Tip number 2. According to Funik et al., regret bias is a key concept in behavioral finance that impacts how investors make decisions by prioritizing the avoidance of regret over rational, optimal choices. This often leads to overly conservative behavior, like holding onto losing stocks to avoid admitting a mistake or avoiding high-risk opportunities even when the potential rewards justify the risk. In the context of our MBA stock trading game, this bias is particularly relevant because the stakes, though stimulated, feel high, and every decision can be scrutinized by our peers. Regret bias might make us hesitant to sell a poorly performing stock, thinking, what if it rebounds tomorrow? Or push us to follow the crowd in fear of missing out, or even when the data suggests otherwise. To manage this, we can adopt strategies like regularly reviewing our portfolios with objective criteria rather than emotions, focusing on long-term goals instead of short-term reactions, and embracing the idea that not every trade will be perfect. By recognizing and minimizing regret bias, we can not only perform better in the game, but also prepare ourselves for real-world investment scenarios where similar emotional challenges arise. So there you have it, a crash course on behavioral finance. It's not just about numbers and spreadsheets. It's about understanding ourselves. By recognizing these cognitive errors and emotional biases, we can make smarter financial decisions. And hey, if you found this video helpful, don't forget to like, share, and subscribe. Let's keep learning together. Thanks for watching, and we'll see you in the next one.